started, and we are going to do our best to get through the rest of Chapter 5 today. With some luck, we may even get through our homework questions or quiz questions, whatever we're calling those for this chapter. If not, we'll do those next time, okay, on Monday. You'll be able to look at those over the weekend, okay? But remember, we left off, and we actually had left off really talking about the different cost flow assumptions for our inventory. We talked about first in, first out being the most prominently used. Lifo sort of coming in second here because of certain tax advantages to using the Lifo method. We talked about weighted average being used, even though they're calling it average cost here. We're going to describe it as weighted average is more accurate. I think they just probably call it average cost because it couldn't fit the word weighted on this pie chart. And then we're going to see that there's some other methods. We won't talk too much about those in those classes. Those are sort of nerdy accountant's methods for keeping track of the inventory. I am recording this lecture. I'll put it up on Canvas along with the slides. Don't be put off if it's a little echoey because my little external mic, I forgot to charge it, so I'm talking into the regular computer mic, so you might hear a little class echo. Shouldn't be too bad. Should be able to understand it. Okay. For folks that I had to make an adjustment to your exam score, see me after class so I can fix that because I want to get that done. Okay, for the couple people that I had to make a little adjustment for.
What about for if you know how there was a one question mark discrepancy, and so you're going to add points to the test?
Yeah, how many were those supposed to be?
I think 3 points.
4 points?
4 points.
Okay, I'll do that, don't worry. Just keep reminding me. Okay. Where are you from? The person that said 5, huh? Where are you from? Where are you guys from? Fremont? You can't talk to someone from Hayward like that and think that you're going to get away with that, okay? Don't give me none of that Fremont jive. Okay. All right, so we'll add the 4 points back, okay, guys? Okay, so let's go ahead, though, and let's start out talking about the first in, first out inventory method. First in, first out, FIFO, okay? What FIFO says is the most recent things that I purchased for my inventory are still sitting. I'm going to move this if you don't mind. I don't know why this thing scares me. I'm going to put this in front of my house for Halloween. Okay, so what's happening? The most recent things that I purchased are still in my inventory, and what I'm going to sell to you are the things that I purchased sometime back. Okay, and I want to do this because I want to sell you my inventory if it's food, for example, before it spoils. If it's clothing, I want to sell it to you before it goes out of fashion or something like that, right? Now, with these cost flow assumptions, it doesn't matter if our goods actually flow in this manner. We just assume that they flow in the manner that I'm about to describe to you for first in, first out inventory method, okay? So the reason I didn't go into slideshow mode is I want to be able to toggle back and forth to this other software where they have this pad on here that I like to use because this pad gives me a little bit more room than just a blank PowerPoint slide, okay? And so you don't need to write anything down, just sort of follow. This is sort of like a movie. Do you take notes at the movies? Good. If you do, stop doing that, okay? All right, so let's go ahead and let's just sort of picture this whole FIFO example, okay? And if we're dealing with FIFO inventory, and by the way, I always have to say this, is there any reason why Microsoft can't just have nice little easy pens up here at the top like this for me to choose from? They got to have disappearing things, and I got to click on them 52 times to make them work right. This software has nice little pens that I can use up here, but let's just use, which has nothing to do with this example, but let's just go ahead and let's do this example. And so what happens? Have you ever been to a Safeway? Do they have Safeway in Fremont, or do you guys still go straight to the cows for milk. Okay, so we have what? We have a Safeway, okay, and then we go all the way to the back of Safeway, and there's a milk fridge sitting there, isn't there? Okay, and what happens in that milk fridge? They have milks that they bought, say, on October 1st. Okay, let's say those cost $4.25, whatever a gallon. I'm just making these prices up. Okay, I don't know what it costs for a gallon of milk. That sounds about right. Then what? $10.15. This is what Safeway paid for these, by the way. They paid $4.50 for those milks that they got on $10.15, and then they bought some milks, say on $10.31, and let's say they bought those for $4.75. Okay, now what happens? Does Safeway own any trucks? You bet you. If you don't get out of their way, man, they'll run you over on the highway, right? Okay, they got a lot of trucks. Safeway does. Okay, so they have the trucks, and the trucks are going to what? They're going to deliver those milks into the milk fridge, right? Okay, then what's going to happen? Here comes what? Who's this? That's you, okay? And you're going to come and you're going to buy the milks, aren't you? Okay? Now, under the first in, first out inventory method, the presumption is that you're going to grab that one out of the milk fridge and you're going to put that $4.25 one in your cart. Is that what you do when you go to Safeway? What do you do? Huh? You go all the way to the back and pick one out? Okay, so what does Safeway do? They change the date on the dairy products. No, okay. No. So what happens? So, this is a cost flow assumption. We are not sitting here and saying that the goods have to flow this way. So it really doesn't matter if you grab to the back, or I don't care if you go all the way and beat up the truck driver and take the ones off the truck. It doesn't matter. We're going to assume that it's the $4.25 ones that you're going to take first, right? Okay. Now, of course, Safeway wants to make a profit on these, so they're going to charge you what, $5 for these? They paid $4.25 from the farmer or whatever, from Berkeley Farms or whatever, and you're paying $5 to them because they want to make a profit on it, right? Okay. Okay, good. So that's first in, first out. We assume that the first things that they sell you are the things that were first in for them a long time ago, right? That's the first in, first out inventory method. Now, let me ask you a question. How much profit do we assume that Safeway made on these if they sell you these $4.25 ones? We assume that they made 75 cents on this, didn't they? Okay, because they charged you for $5, and it was a $4.25 cost, and so their gross profit, we have their sales price minus their cost of goods sold. So their gross profit here is going to be what? Is going to be 75 cents, right? Where do we report gross profit? When I ask you where do we report something, I'm either asking you the balance sheet, the income statement. So where do we report gross profit? On the income statement. Sales minus cost of goods sold is reported where? On the income statement? Okay, good. Now, they sell you those. What items are going to be sitting in ending inventory? Ending inventory are doing what? Showing you those $4.75 ones, aren't they? Sitting in their ending inventory? Because they haven't sold those yet, or at least they're assuming they haven't sold those yet. Even if you reached in the back and grabbed the $4.75 ones, we still assume that those are sitting in ending inventory. That's the Fifo inventory method. Okay? Question? Okay, good. Did everyone bring with you the example, in-class example that I handed out last time? This one up here. Everyone brought that one? Anybody not having it? Okay, good. So, you come over, and we're going to use this example now. Anybody else? Okay, and use this example here, and we're going to go ahead and we're going to start ourselves out with this example, assuming, and we're going to go through it with Fifo, Lifo, weighted average, but we're going to start ourselves out with Fifo here first. Okay, so just come over to where it says, see where it says Fifo? See Fifo? Actually, I lied. Let's read the fact pattern first. Okay, so the fact pattern is what? During its first year of operations, Little Buster's Corporation had purchased its entire inventory in 3 separate batches as follows. So they have these 3 separate batches. They bought batch 1. And let's just go ahead and write in some dates on these that match up to the little example with the milks that we just had a minute ago. So for this batch 1, okay, we'll put in what? The 10-1, just to tie it back to our little example a little bit, even though we didn't have units, specific units in that one. And then we had what, 10-15 for that second batch and 10-31 for the first batch, right? For the third batch, I mean. Okay, 10-31. And if you look, they purchased a total of what? 9,000 units in these 3 batches. And the problem is telling us that they sold what? 4,000 units. So you take the 9,000 minus the what? 4,000. That means how many are left? 5,000 are left in ending inventory, right? Right? Okay, what we're going to try to figure out here is how to price these. Okay? Forget this part. Scratch that out. I keep forgetting to take that out. I want that out of there. Forget that part. Just worry that 4,000 units in total were sold, and there's how many units left? 5,000 units left. Don't worry about whether they sold what before what batch. Take that part out. Okay? Now, and of course I wrote that here, and I could have just gone ahead and stuck it, pointed to here. Beginning inventory was 0. 9,000 units were purchased, so there was 9,000 units available. They sold 4,000, so that means that the ending inventory is how many? 5,000 units, okay? And so what I'm asking you under the 3 methods here, and this is the way the exam questions are going to look, we're going to sit here and we're going to ask you what is the ending inventory and what is the cost of goods sold. So the ending inventory is going to be what? Those 5,000, and the cost of goods sold is going to be those 4,000, isn't it? Okay, and I'm going to ask you under each of these methods, expect you to be able to answer a question under each of these methods. Right now, we're going to jump down to our buddy Fifo here, aren't we? Okay, and so what happens? They sold 4,000 units, and if they sold 4,000 units, you go back up to the table there, and for instance, it's first in, first out. We're going to assume that they sold those 4,000 milks that they bought on 10-1, right? First in, first out. The ones they bought back on 10-1 are the ones that get sold first. So we take those 4,000 units, we multiply the 4,000 units times the $4.25 price for that first batch. That first batch was at $4.25. They sold all of those, didn't they? Don't we assume that? Now, I don't care if you reached in the back and grabbed some of those later ones. We're going to assume that all the 4,000 that came in at 10-1 got sold first, right, at $4.25? So calculating cost of goods sold is a piece of cake. We just sit here and we take the 425, and it's all 4,000 of those units. They're all gone now, aren't they? How many did we have left in ending inventory? We had the 5,000 left in ending inventory, and when we cost those out, 2,000 of those are at 450. How do I know there was 2,000 at 450? Because you look back up at the table, and that was that 10-15 batch. 2,000 got bought at 450, right? And then the remaining 3,000 to make up the 5,000 were at 475, and so I go ahead and I price those remaining 3,000 at 475, don't I? Right? So I just do the extension. The 2,000 times the 450 is 9,000. The 3,000 times the 475 is 14,250. I go ahead, I add those two numbers together. There's the value of my ending inventory. Have I answered the question? That's it, guys. Welcome to Fifo inventory method. First in, first out. We assume that we sell what? From that first batch that comes in. If we use up that batch and we still have to sell some more, those would have come from the second batch and so on, right? Anything that's left over, we assume are in those later batches, right? Yes, sir. This is what's left after I sold these 4,000. The 4,000 are gone now in this assumption. Just coming up to the original table. I'm assuming these are all gone. Because I had to sell them 4,000, didn't I? Problem told me I sold 4,000, so I'm assuming those are all gone now. Right? And I have how many items in ending inventory? 5,000, and there's my prices for those 5,000.
I was wondering if the price per unit, since they're on all lines, like
The assumption is that, no. I know I sold 4,000. The question,
5,000.
what about them?
It's like the number that you get, the price per unit, like that number at the end, after you calculate it all up. Is that just how you assume what the value is?
No, that's what I paid for the last 5,000 that I know I have in ending inventory. I mean, I assume that that's what I paid for the last 5,000. I know I have 5,000 in ending inventory, and I look at my cost sheets and I say, okay, the 5,000, 2,000 I paid 450, 5,000 I paid 475, right?
So this is how much you paid for, that is how much you sold.
No, I sold them for $5.
Okay.
But I assume that I sold all of those 4,000 that I got at 425.
Okay, I was just wondering where if this was something you sold, like this is
Yes, it's both. It's something that I sold after I bought it. I bought it and then I sold it, which is what retail businesses do, right? And so Safeway paid $425 for the first 4,000. They paid $450 for the next 2,000. They paid $475 for the next 3,000. They sold them all for $5, right? Okay? And so what happens? We assume that we sold those 4,000 ones, and we're going to cost those on our income statement at what? At $425. So if they were preparing their income statement right now, what? $425, $5 times 4,000 is what? 20,000? What's my sales here? 20,000? Right? $5 a pop times 4,000 milks. Right? And my cost of goods sold, which I already know from looking down here, under FIFO anyway, maybe I should be writing that next to FIFO, but I know that I just calculated my cost of goods sold to be $23,250, didn't I? Oh, I'm sorry. Thank you. Yes. My ending inventory, I mean, my cost of goods sold, I just costed it at $17,000, didn't I? Okay, so I could ask you on your exam, giving you all that information, I'll just ask you, what's their gross profit? And you need to know if they sell them at $5 a pop, and we're assuming that they sold them for $4.25 a pop. Would we say that's 17,000 even? 17,000 even is the cost of goods sold. So the gross profit's how much? 3,000, right? Right? Okay? Okay, that's FIFO. Any questions? Okay, good. Now we come over and let's go ahead and let's look at LIFO. But before we do, let's go back to our little chart over here, our little drawings. I don't know that I should even glorify this by calling it a chart. Let's look at our drawing and let's just do a FIFO, a LIFO. LIFO is last in, first out. Okay, and this is a pile of rocks. Okay, I was having some work done in my backyard, and I told these guys, oh, I don't want to put bark in there. I want you to put rocks in there because the bark gets old, and then you got to replace it all the time. I just want to put rocks so I'm done with this thing. They said, okay, fine, you got to come and you got to pick the rocks out. I'm like, no, just put whatever rocks you think. They said, no, you got to come with us. Okay, now, I'm pretty sure that what happened is those guys had probably done some work at a house before, and they delivered, 10 tons of rocks in somebody's backyard, and then the person went, oh, I don't like those, right? And trying to take rocks out of a yard is probably much worse than putting them into a yard, right, where you're just dumping buckets. So they said, nope, you're coming or we're not doing it. I said, okay. So I reluctantly go to the rock place, and all of a sudden, you're counting ahead, I look around, and I'm like, oh, a true LIFO inventory. The cost really is flowing at LIFO. What happens? Here comes a little delivery truck that delivers rocks to this rock vendor, and he goes ahead and he dumps the rocks, and then when he comes back with another load, he dumps on top, and he dumps on top, doesn't he? Right? And so what happens? Down here at the bottom, you have these 425 ones. Right, and then he comes with more rocks that the rock vendor paid $450 for, and he dumps on top of those. And then he comes with some more rocks that the rock vendor paid $475 for, and those are sitting on the top, right? Then what? Then here come me and those guys that kidnapped me and brought me to the rock place, right? And what happens? You sit here, and here comes their little truck. And they don't go to the guy, hey, do you mind if you can knock off to the bottom because we want some of them 425 ones? What happens? No, they're going to what? Pull off of the top, aren't they? They're going to pull those off the top? Okay, and they'll just keep going on down to the bottom, won't they? Last in, first out. The last thing that they receive is the first thing they sell you, right? Okay, last in, first out. So what happens here now? Let's go back to our little example. Okay, and let's look at the LIFO one. Now, same set of facts. Let's review the facts. What is it? They bought 3 batches, 4,000 in the first batch, 2,000 in the second batch, 3,000 in the third batch, right? But now what's happening? Now, since it's last in, first out, when they sell those 3,000, what'll happen? Since when they sell 4,000, they're going to assume that they first sold all of these, aren't they? They sell all these first? So those will be all gone. How many did they sell total? They sold 4,000 total. So we still need another 1,000 units, don't we? So we'll what? We'll sell 1,000 of those. 1,000 will be sold. It says 1,000 sold. And then there'll be 1,000 still here, right? Because now we've sold our 4,000, so there's 1,000 gone, 1,000 still here. And then the assumption is what? All 4,000 are still here of the 425 ones. Those are sitting at the bottom of the pile, aren't they? They're all still here. Okay, so blue is now LIFO. Okay, and so you come down and you take a look at the LIFO situation. And with LIFO, now what happens? Well, let's get our cost of goods sold first, because that's what I'm going to ask you, cost of goods sold, and then I'm going to ask you ending inventory. Cost of goods sold is what? 3,000 plus the 1,000 units. The 3,000, we assume they sold all 3,000 of those from batch 3, didn't we? At $475. So that comes out at a cost of $14,250. And then what? Then we go ahead and we sell 1,000 units, and we sold those at $450 from that batch 2, right? So our cost of goods sold is what? The sum of those two, 14,250 plus 4,500, gives me my cost of goods sold, 18,750. And then I want to figure out my ending inventory, 5,000 units in ending inventory. We assume that there's still that 1,000 from batch 2 that were priced at $450. We extend that out. And then we've got those 4,000 down there at the bottom in batch 1 at $425. So we assume those are still in ending inventory. They're valued at $17,000, right? So to get the ending inventory, we add the $17,000 to the $4,500. There's our value of our ending inventory. How many items did we sell? How many items did we sell? We sold 4,000 items. Our presumption is what? We sold all 3,000 of those ones that were sitting at the top of the pile. We sold all of these ones here. They're now what? Those are all gone, aren't they? Now we need what? Another 1,000 units to make up the 4,000. So now we're grabbing these, aren't we? Right? And then what? And then in ends, almost all of those are gone. Half of them are still here, I guess. There's 1,000 still here, plus what? Plus the 4,000 sitting down here, because we have 5,000 items in ending inventory, don't we? Okay, that's all that's going on here. And all we're doing in the little, in the example here for this Buster's company is we're sitting here now and we are simply what? We are simply, where'd I go? I'm right here. We are simply extending the prices out using the Lifo example, right? Who wasn't here last time?
Can you hand that back?
Straight back. You were here last night? Okay. Question? Okay. Lifo, Fifo, weighted average is the other method. Weighted average, it turns out, is the easiest of the three methods. Weighted average is a piece of cake. What do? We sit here and we look at how we purchased these. We purchased 4,000 at $425, didn't we? Then what? Then we purchased 450 at, 2,000 at 450? Just going through the batches? And then what? And then we purchased 475 at 3,000. So we what? Paid a total of 40,250, didn't we? And we purchased what? 9,000 units. That gives us a weighted average price per unit. And if you're doing this in your calculator, which I know you guys got bit by a calculator when you were a kid, right? And now you don't want to touch a calculator anymore, okay? So if you take this, what? You take this 40,000, where'd my number go? 40,250, and you divide that by 9,000, you're going to get some number like 4.4444447 or something like that. It's okay, whatever. Okay, in order to get these two numbers, you got to leave that irrational, funky number in your calculator. Otherwise, you won't get that exact number. So if you're saying, how come I don't get that exact number? It's because you use the rounded number. You got to use the fully irrational number, and you simply multiply what? By the 5,000 units that are sitting in ending inventory that we know we have left, by the 4,000 units that we know we sold. I've got my cost of goods sold and I've got my ending inventory, don't I? Isn't that the easiest of the three? Okay. Question? Okay, good. Let's go ahead then And let's jump into year 2 of this example. By the way, guys, don't forget the pattern here in this class. Slides, in-class example, practice exams, midterm, right? So you need to be paying close attention to what's going on here and making sure you're understanding this, right? Because you know that this is going to parlay into exam questions. Okay, so we go ahead now and we have them go into year 2. Okay? And they go into year 2 and we know we have beginning inventory of what? 5,000, right? Okay? And then they purchase an additional 7,000 units, so they got 12,000. They sell 9,000, so there's 3,000 units in ending inventory, right? And we're going to go through again, and we're interested in cost of goods sold and ending inventory under Lifo, Fifo, weighted average, right? Okay? So you come in, and let's just do weighted average first. And the first ones come in at what? 447. Wasn't that our average, our weighted average cost for the items in ending inventory? So we just bring in that ending inventory at, now it's beginning inventory. We bring in what was our ending inventory at the end of last year as the beginning inventory at the start of this year, right? Right? You go to sleep, your inventory is sitting next to you, you wake up the next morning, you go, good morning inventory, and it's still there, isn't it? Okay, and it's what, January 1st now? So last night's ending inventory is today's beginning inventory, right? Okay, so there's the beginning. And then I simply add in the items that I bought. They only bought one batch in year 2, this batch 4, at 7,000 units at $5 a pop. That's 35,000. I bring that in. 22,361 plus 35,000 means I have total cost of what? 57,361. I divide that by how many units now? 5,000 beginning plus the additional 7,000 I bought. That's 12,000. I do the division and I come up with what? A new weighted average cost per unit, don't I? Okay. I take that weighted average cost per unit, this 478, and since the problem told me that there was 3,000 units in ending inventory, I can figure out my ending inventory right there. And since they told me there was 9,000 units in my cost of goods sold, I will go ahead and multiply the 9,000 times that weighted average. Was I able to calculate my weighted average ending inventory cost of goods sold? Piece of cake? Okay. Okay, good. Let's go ahead and let's do FIFO now. Okay. Now with FIFO, meanwhile, back at FIFO, we had what? Yes, sir. Question? Yes, you needed to get 4.47 times the 5,000.
Okay, not just the total.
Yeah, so it's just a rounding is all it is. It's just a rounding error, and I won't ever give you a choice in which the rounding error becomes an issue. Okay? Yeah, it's a rounding error, that's all. Okay? Okay, so let's go. Yes, sir. Yeah. Batch 4, we bought 7,000. Batch 1, 2, and 3 were in year 1. Batch 4 was in year 2. Batch 4, and we bought 7,000. We sold 9,000. Okay? So if we're sitting here and we're using FIFO, remember our beginning inventory had what? 5,000 units sitting in it. It was the what? The 3,000 from batch 3 and the 2,000 from batch 2. Wasn't that the 5,000 units? And first in, first out, presumption is we're going to sell those batch 2 ones first, then we'll sell the batch 3. And then if we need some more, we'll take them from batch 4. Batch 1, we consider all gone. Remember, we assume we sold all 4,000 of that batch 1? Okay? So that's all we do here for FIFO. We go ahead and we sit here and we say, okay, 2,000, all of the units from batch 2, we're going to sell those first at what? 450. That gives us, for our cost of goods sold, 9,000. then what? Then we go ahead and we sell an additional 3,000 from batch 3. We sell those at what? 475. That's 14,250. So now we've assumed that we sold all of batch 2, all of batch 3, haven't we? Okay. So we still need what? 2 plus 3 is 5. If we assume we sold 9, we need 4,000 more, don't we? Can't go to batch 1. Those are all gone. So what do? We pick up 4,000 units from batch 4, and now we're assuming that they're paying $5 a piece for those. So that's what? That's going to be 20,000 for that. So we add those 3 together. The what? The 9,000 from batch 2, the 14,250 from batch 3, the 20,000 from batch 4, and that gives me a cost of goods sold of 43,250. Okay, and then remember, I'm assuming that what? That I'm still left with what? 3,000 units in ending inventory, right? And I assume those 3,000s are those ones in the back of the fridge that are cost at $5 a piece. My ending inventory is 15,000, right? That's from batch 4. Okay. Okay, good. If we're doing LIFO now, what do? We go ahead and we assume that we sell the stuff that we most recently got delivered on the top of the pile first, right? How many did we sell? 9,000. So we go ahead and what? The first 7,000 are off the top of the pile, aren't they? Okay. The next 1,000, just going back to our little, cartoon drawing over here, the next 1,000 are going to be these that were left from that batch 2, aren't they? Right, because we're coming down. There weren't any of these. They put those, what was it, 7,000 on top, but then they sold all those. The 475s they sold last year, they still had 1,000 of 450. Now they're going to sell those, aren't they? Right, so they sell all of those out, so those are all gone. Okay, so there's those 1,000 at 450, they're all gone. And we sell 1,000 of those at 450, they're all gone. And then what? We sold 9,000, we still need 1,000, don't we? So we have to pull 1,000 now from what? From that bottom batch, the 425 ones, right? That we were assuming we're sitting down there at the bottom. There was still supposedly 4,000 of those. Now we're going to only sell 1,000 of them, right? And we sell those at what? 425. That's a cost of 4,250. So we add up the 3 costs, which is what? Why did I put 25,000 here? This should be what? Those come out at 35,000, right? Little typo there. 35,000 plus what? Plus the 4,500 plus the 4,250, and I think my math was right on it. I just typed in the wrong number.
Yeah.
It adds up to that number though, right?
Yeah.
Okay. There's my cost of goods sold. My ending inventory is what? The 3,000 that were left at 425, right? Okay. All right, good. Now, let's go back to my gross profit calculations. Remember we were doing gross profit calculation? And we did what? We did our gross profit calculation. Let's just do it again so it's written next to the right one. Let's do it again for FIFO here. FIFO, what was my sales price? $5, right? A piece times the 4,000. Yeah, let me fix that. So it was $4. I mean, what? $5 times what? 4,000 units. So my sales were what? 20,000. That's my sales. And then we said that my cost of goods sold, which is right there, is 18,750. Oh, sorry. Jump down to Lifo. What are we doing here? Lifo, thank you for paying attention. The FIFO cost of goods sold is how much? 17,000. Is my cost of goods sold. So what do I call this difference? Good. That difference is gross profit. My gross profit's $3,000 using FIFO, right? Okay. If I'm sitting here and I'm using Lifo, inventory method, my sales price is still $20,000, isn't it? Because I'm still selling them for $5 a pop. 5,000. 20,000. Right? Is my sales. But now my cost of goods sold is what? 18,750, and it should be a little higher because I have a period of rising prices, don't I? Aren't my prices rising?
Yes.
My costs rising. I'm going from 425 to 450 to 475, and I'm assuming that I sold those more expensive ones first, right? Under LIFO, the ones on the top, the 475 ones. So since I have rising prices here, what happens? My gross profit goes from 3,000. Somebody got that number for me? 1,000 or 2,000? 1,000 what? 250? So I've got a drop in gross profit, don't I? If I have a drop in gross profit, am I going to have a drop in net income? I'm going to have a drop in net income, we know, right? Because net income, gross profit minus my operating expenses is going to give me my net income. So my net income is going to come down, right? So I'm going to show a lower net income under LIFO in a period of rising prices than I would under FIFO, right? Because I'm matching my older, cheaper cost against my current selling price, right? So which method would you rather use? You want to use FIFO so you get a bigger net income? Why do you want to get a bigger net income? You make the same amount of money. It does not matter. How much actual money you make is not relevant here. You bought those milks, like somebody could have came in and bought the milks and pulled them out of the back, right? And you're going to be selling them however. So this has nothing to do with how much money you make. It has to do with how much income you report, right? So depending on what method we use, we're going to report a different net income, aren't we? And they let us choose which method. It has nothing to do with the amount of money I made. I made whatever I made for the ones I sold at $5 a pop, and I paid for all of those milks, whether I'm assuming that they're still sitting in ending inventory or whether I'm assuming that I sold them at this point, right? I'm still going to end up making the same money. We stopped operations at year one. There's going to be no difference in my ultimate net income whenever I get around to finally selling those, right? Yes, sir. What do you think? If I report a lower net income, do I pay more tax or less tax? Less tax. Okay, if I'm still going to make the same amount of money, what method do you want to use now? You want to use LIFO because you're thinking, hey, I'll pay less tax, right? Right, because I'm going to report a lower net income. At least in year one, I'll pay less tax. Eventually, I would end up paying all the same amount of tax, right? But if I get to go year after year after year after year, sort of using LIFO instead of FIFO, that's going to help me eventually, isn't it? In fact, if you're Trump, you can set it up so that you take so that you take so many losses that then you can carry them back year after year after year, and you never pay taxes, right? Okay?
If you said LIFO is better for the taxes, you're saying in LIFO it's basically the more expensive one goes first, so that means your income's higher, so that means you get taxed more.
What do you mean the more expensive one goes first, so my income's higher?
Do you remember the rocks example? The top ones are more expensive.
Who? The rocks?
Yeah.
Yeah, and I sold those first. That $475 price is what I am paying for that inventory. The $475 on those rocks is not what I'm selling them for. I'm selling them for $5 regardless. Okay, the $4.75 on the top of those rocks over there, that $4.75 is what the rock seller sold them for. I mean, bought them for. Now I've scratched it all out. But the $4.75 ones here, that's what he paid for them. The $4.75, that's what Safeway paid for the milks. They're selling them to me for $5. Are you going to make more money if you sell me something for $5 that you paid $4.75 for? Or are you going to make more money if you sell me something for $5 that you paid $4.25 for? $4.25, right? So they're reporting more income if they say that they paid $4.25 for those than if they paid $4.50 for them, right? So you're with me now? Well, look, man. I mean, this is not, nuclear physics that I'm talking about up here. What? Okay. You sure? Okay. All right. So what's happening? If I paid $5, if I sell them for $5 and I paid $4.75, I'm going to make less money if I paid $4.25, right? So that price is what the vendor is paying for, right? Okay. So what happens when we have a period of rising prices, like we do in this example? Okay, we have a period of rising prices like we do in this example. I didn't want to go back here. I wanted to go back to here. Then what's going to happen? Then Fifo is going to show us a higher net income than is Lifo, isn't it? So you're sitting there and you're saying, well, then if that's the case, I want to use Lifo, right? So why would a company ever use Fifo? In fact, why do most of the time the companies use Fifo? Shouldn't everybody be fighting each other to use Lifo then if it's going to give you a lower tax? This has nothing to do with the actual flow of goods. They could be grabbing the milks all the way from the back. We're first going to assume Fifo. So the actual flow of goods is irrelevant. In fact, but you're on the right track because most goods flow in a Fifo manner, don't they? Right? And so it happens. A lot of companies, most of the companies, choose Fifo because their goods actually flow in that manner, and so they don't have to sit there and have a separate accounting system that pretends, a pretend accounting system that pretends that the goods went out in a Lifo manner when in fact they went out in a Fifo manner. And they sit there and they do the cost-benefit analysis. How much is it going to cost us to have this separate record-keeping system where we have to sort of have this pretend flow of goods versus the actual flow of goods, right? Because you want to know what your actual flow of goods are. So you're going to have that secondary system that's keeping track of this sort of assumption flow. And they sit there and they say, is the cost of maintaining that system more than the benefit of the tax savings? And if it is, they just go with Fifo, don't they? Okay, so it's a smaller number of companies that use Lifo. Usually companies that are using Lifo are companies like oil companies, companies that have significant amounts of inventory, that have high costs and have rising prices with that inventory. They tend to like to go ahead and bother to use Lifo. Okay? Now, a problem though with Lifo is this. If you choose to use Lifo for your tax purposes, the rules are, SEC and the FASB say that you must use Lifo to prepare your financial statements. This is not Sudoku time. I mean, don't do it in the front row. Don't be afraid. I did that Pokemon. Okay? Okay, what was I talking about now? So what's happening? You sit here and what? You have to use Lifo for financial reporting purposes if you use it for tax purposes. That's a rule. Okay, so what happens? They're going to say you can't have your cake and eat it too. We're not going to let you report a bigger net income for your financial reporting purposes. Meanwhile, you're doing what? you're paying less tax on your tax purposes. So you have to have, they call that the Lifo conformity rule. You have to, if you use it for tax purposes, you must use it for book purposes as well, right? For your financial reporting purposes. Okay, but some companies go ahead, they say, that's okay. We'll report the lower net income. In fact, the analysts look and they say, okay, we see what you're doing. You're using LIFO and you're going to have a nice tax benefit. We get it. We're okay with that, right? And they take that into consideration. Okay? Now, you come over and let's just go ahead now and start to take a look at, and we can just go ahead and come up into the slides now. First in, first out. Cost of the earliest goods purchased are the first to be recognized into cost of goods sold, right? Huh?
Just going back to the last thing, how much is the difference between having a separate reporting system if you're making that much of a, like a profit more doing LIFO rather than FIFO? Is it really that expensive?
It depends on the company, but there is certainly a cost associated, right, with having to have a separate record-keeping system for the...
Yeah, but that much of a, significant difference.
I don't know. I mean, it depends on the company, right, and the value of their inventory, et cetera, right? So I really don't know. But, I mean, what this slide is telling us is in most cases it's probably not that significant. Whereas, and that's why I was calling out like oil companies, companies that have lots of high-priced inventory are probably going to decide to use the LIFO method, okay? Whereas if you have, if you're Safeway, you probably use FIFO. You have a lot of inventory. Your inventory is relatively low cost, right? Items, and so. But I don't know. Somebody from Safeway could come in right now and say, "You have no idea what you're talking about. We've been using LIFO since LIFO was invented." I have no idea, but to actually use, okay? But I'm just saying maybe that's the case, okay? But you can see from here that most companies are going to use FIFO, so they've made the decision, hey, it's not worth the cost, okay? Okay, but I know that oil companies do because that gets talked about all the time, okay? So what happens? First in, first out, okay? And the ending inventory is going to be what? The most recent purchases, isn't it? Right? Okay, so we're just simply seeing now on these slides what our little example just gave us. Okay? Okay, good. Now you come over and you take a LIFO and the costs are what? The latest goods purchased are the first to be recognized into cost of goods sold. And again, the actual flow seldom coincides, and again, that's why we're going to have to sit there and have a separate pretend, and when I say pretend, guys, I don't mean a fraudulent. I mean what? A system it's certainly allowed, but it sits there and it has to keep track of something that isn't the actual flow of goods, right? Okay? And what? And then they give us exceptions such as piles, things stored in piles are rocks, whatever, right? Coal, etc. But for the most part, it seldom coincides, okay? But the items that are sitting in ending inventory, they probably should have told us. Is there another slide coming here? No. The items that are in ending inventory are the first ones bought, right? Let's add that in. Okay, the items in ending inventory are the first ones bought. On the bottom of the pile. Okay? Okay, good. And then average cost, we simply use the weighted average. And I'm saying in class example time because there was a time when I would go through all the slides first and then do the examples, and then I realized that the slides make more sense if we do the examples first. So we've done the examples now. Okay? Question?
Is there a reason why average cost is not just how they adopted it as specialists?
It's going to be another record keeping issue. Okay, because what are we doing? We're sitting there and we're having to figure out, okay, what was still here, what was the cost of those, add in the cost of the new ones, that gives me a weighted average cost, okay, what's still here at a weighted average cost, bring in the new ones. It's certainly easier than LIFO, but it's still having to have a separate calculation as to what's going on, right? So... And remember, we're talking about, one batch, two batch. I mean, imagine if you got a company that's got 50 million batches of things, right? And that can start to get a little cumbersome. Okay? Okay, good. So we come over, balance sheet effects, major advantage of the FIFO method is that in periods of inflation, the costs allocated to inventory will approximate their current cost. Just go back, and I shouldn't have gone into slide mode. Just go back and take a look at our little picture here. Right here. If this guy rolls over these milks and crushes them all, and we have to replace them, how much are we going to pay for them? We're going to have to pay $475 for those, right? Because we just bought them a minute ago. On November 1st, we're going to get a new delivery at $475. So the items that are sitting in ending inventory that we're assuming are in ending inventory, we're reporting our ending inventory pretty much at what we're paying currently for it, right? So that's an advantage of where we're reporting our ending inventory. Our cost of goods sold is over here, right? Where are we reporting our ending inventory? In the back. On the balance sheet. Good, we're reporting it on the balance sheet under current assets, right? And when I was saying it's in the back of the store, we're sitting there and we're saying it's on our balance sheet is in our ending inventory, right? Our cost of goods sold is what? On what statement? Is sitting there on our income statement, right? So if we're using FIFO, what we're reporting for our ending inventory on our balance sheet is pretty much matching what we're currently paying for it, isn't it?
Yeah.
Okay? However, on our income statement, the cost of goods sold that we're reporting what? $425 per item is our cost of goods sold. So our cost of goods sold isn't quite reported at the current cost of those items, right? Right? Because we're paying now $475. Meanwhile, at the beginning of the month, we had only paid $425 for those, right? So that's a disadvantage. So you take a look back at that slide, and you take a look back at the slide over here, and an advantage of FIFO is that the balance sheet looks good. Our ending inventory on our balance sheet is pretty much being reported at what we have currently paid for that, right? On the balance sheet, BS, balance sheet, pen. So our what on our balance sheet is okay? Okay? But when we get to the income statement, we say what? A shortcoming, well, let me right here, yeah, okay. A shortcoming of the Lifo method is that what? In period of inflation, the costs allocated to ending inventory, oh, that's Lifo. Okay, sorry. Sorry, I thought they had FIFO. This is balance sheet effects, I get it. Okay, sorry. So take the income statement off of here. We're talking FIFO, Lifo. For FIFO, what? The balance sheet is showing the current cost for FIFO. For what? For the Lifo method, the balance sheet is significantly understated, and again, it depends on how the price level has changed and how many units we have there. But if you go back and you look at the rock pile, although I've kind of scratched all over it, our ending inventory is right here, isn't it? In the bottom. Okay, meanwhile, our cost of goods sold is coming out up here at these higher priced ones. Okay, so my ending inventory is understated, right? Because I'm reporting those $425 ones, even though now I'm paying what? $475 per pound of rocks or whatever it is. Okay, so our balance sheet is better under what? Is better under FIFO than it is under Lifo. And that's not what I wanted. I wanted to go back here. So which one's better for the balance sheet? FIFO is better for the balance sheet. Okay, for the balance sheet. Lifo is what? Lifo is worse. Better? Worse, right? Right? For the balance sheet? Okay. For the income statement, They don't tell me anything about the income statement here. They move straight to tax effects. Let's just do it. For the income statement, what's happening? Income statement now, let's just look first at the picture. Okay, income statement, what's happening? We're reporting our cost at $425, aren't we? Meanwhile, our current cost for those items is how much? $475, isn't it? Right? What else? Over here, for the under Lifo, for the income statement, we're pretty much reporting our cost of goods sold at our current cost, aren't we? Okay? So, let's just go ahead and put down there somewhere on that next slide that's talking about tax effects, that for tax effects, what? Income statement Fifo is what? Worse. Whereas Lifo is going to be what? A little better, going to show the what? Show a more accurate picture of our net income. Okay? Okay, so what happens? For our tax effects, both our inventory and our net income are going to be higher, aren't they? Right? Our inventory will be higher because we have those what? Those higher cost items in the back sitting in our ending inventory. Our cost of goods sold will be higher because we're now saying that we're doing what? I mean, our cost of goods sold, will be what? Will be lower, so our net income will be higher, right? Okay, Lifo is the opposite. My ending inventory is going to be lower, the 425 ones. My cost of goods sold is going up, so my net income is what? Coming down, right? Okay. Okay, good. Now, IFRS, International Financial Reporting Standards, does not allow, okay, International Financial Reporting Standards does not allow companies to use Lifo. They just say no to Lifo. Why do you think they say no to Lifo? The international standards will not let a company, if you're trying to follow international standards, they won't let you use the Lifo method. How come? Yes, sir. Nah, they don't care. They don't care how much tax you pay. I don't think. I mean, if you listen to Trump, anything international is a conspiracy against the U.S., right? But, so they're all working together to make you pay more tax. Okay, but what's happening? We have what? We have the 425 ones down here. We have the what? We have the 450 ones up here. And we have the 475 ones up here, right? And we're selling those for $5. And if we're selling those at $4.75, then my gross profit's going to be 25 cents, right? Right? So, is there any way that I can set this up so that I can somehow get these 425 ones? Don't say switch to FIFO. I still want to use Lifo, but I want to show a bigger net income. What should I do? I'm going to what? I'm going to say, hey, rock seller, the person who sells the rock guy, the guy who sells the rocks, the person who provides them the rocks, the rock man, okay? Hey, rock man, don't bring me any more rocks for a while. Leave them mountains alone. Don't worry about it. Don't send me any rocks for a while. So eventually what's going to happen? We're going to lower our inventory. We'll get rid of all of those. We'll get rid of all of those. Now we're down to just these that are left, aren't we? And so now, boom, $5 minus $4.25. Don't I look like a genius? I look like a genius. They're like, I don't know how he did it, but he increased net income overnight. he's a genius entrepreneur, what a management wizard, because he sat there and he increased to 75 cents. Now we're making 75 cents before he got here, right? And meanwhile, while I'm driving away going, let me go work for Wells Fargo now, see if I can figure something out over there, right? By the time anyone knows what's going on, I'm walking away with a pile of money, right? Okay? And so what happens? IFRS looked at that and said, we're not doing that. We're not going to let you manipulate your income based on what inventory method you choose. We're not going to allow it. So how come US GAAP doesn't go along with what IFRS says and say, okay, we're not going to allow you to use that method either? Huh? What would happen if the SEC passed the law that said, like IFRS, you can't use Lifo? What would happen? If you can't use Lifo for financial reporting purposes, can you use it for tax purposes? If you don't use it for tax purposes, you're going to have to pay what? More tax. Do corporations like to pay tax? No, and they're big, mighty corporations that don't like to pay tax. Like what? Chevron, different oil companies, and they'll go to Congress and they'll say, if you let the SEC do this, the terrorists have won. And they'll go, oh, okay, we can't. And they'll come up with some story about, oh, well, you know, and that means that Al-Qaeda's going to, you know, mix with ISIS and it's going to be horrible. Okay? And so what happens? They'll lobby, and if you give Congress something and the president something to argue about, what will they do? Argue, right? You think I'm kidding? I looked up IFRS discussion, and you had the Republicans saying one thing, the Democrats saying something else, and they argued about a nerdy accounting issue moving over to the last in, first out. It wasn't last in, first out, it was research and development for that particular one. But there is a group called the Lifo Consortium. And the Lifo Consortium's whole objective in life is making sure that Lifo is maintained as a valid method for keeping track of inventory. Can you believe it? If you find yourself on the Lifo Consortium in life, I want you to check your priorities. But I'm telling you that what? This is how serious they take this. This is why it is impossible for the U.S. to just flip the switch and switch over to what? To IFRS, because of the political ramifications if they try to do something like that, right? So we'll always have differences between US GAAP and IFRS. Okay, guys, look, you know enough now to jump into those quiz questions on your own. There's 2 quizzes up there. Work through both of those. We'll hit those next time, and we'll see where we land in terms of being able to get into Chapter 6. But we're going to continue to roll like this. Class examples, slides, quizzes, okay? All right, guys. I'll see you next time. Hi.
This is really random, but I was
Sure.
looking at the modules and I saw you have this extra credit opportunity. You went over it like the first day of class. Is
Yeah.
there a due date for that? I started it, but
Yeah, get it to me sooner rather than later.
okay.
So the
that's
answer is
fast.
not really, but don't wait till the last
Okay,
minute.
got you.
Yeah, and print it and bring it to me.
Sure.
Because I don't want to box through to 50,000 emails to
Okay.
find in different classes and stuff.
So just bring you a printed out version of
Yeah, then I'll have it and I can keep it with this class's information. I
Okay.
have it. Yep.
Okay,
Okay.
sounds good.
Okay,
Thank
great.
you.
Sure. Mhm.
Are there any more slides that are going to be covering for Chapter 5, or are you stopping there? There's other slides in your slideshow.
There may be a couple.
There's lower cost of market.
Yeah, there's a couple we'll pick up.
There's presentation.
Yeah, we'll pick up a couple more.
Okay. Wasn't sure if I should.
Don't worry about them right now, but we'll get to them. Hi. Yeah, so you want to fix that? So let me do this. Let me